Hello, learners. I hope whatever we have discussed so far, you are understanding the concepts and making the practice on your own. Today, we start with one new topic that is about capital structure decision. As you know, a finance manager, in consultation with the top management authorities, has to decide which type of capital structure is most suitable for the company. When I say most suitable, it means the finance manager is aiming to go for the optimum capital structure. Although thinkers are divided on the point, does there exist any optimum capital structure or not? So we will not fall into that jugglery, but yes, optimum capital structure is there for every company. So depending upon the scenario of the company, risk-taking capacity of the company, earning and profitability of the company can choose an optimum capital structure. So we will learn what is a capital structure first of all, what are the factors which affect decision about the capital structure, and what is optimum capital structure. So let us begin today's lesson. Capital structure. As you know, a company can finance its assets either through equity, debentures, loan, preference shares, or retained earning. So capital structure means proportion of different long-term sources of finance employed by a company to finance its assets. Different assets like land, building, plant, machinery, even the working capital elements, they require the financing. So practically capital structure means composition of different long-term sources of capital employed by a company to finance different assets. In general, we focus on the long-term sources. However, short-term sources are also used by the companies to finance short-term need of the money or the finance. Optimum capital structure is the capital structure at which the weighted average cost of capital is minimum, leading to the maximize the value of the firm. That means out of the given blend of different capital structures, blend may be like this: purely equity financed company. That means 100% equity company, or we say unleveraged capital structure. Whereas slowly we can keep on increasing component of debt in the capital structure and reducing the component of equity in the capital structure. So the moment we include debt or loan along with the equity, such capital structure is called as leveraged capital structure. And one thing is sure, leveraged capital structure is riskier than the unleveraged capital structure. When I say riskier, that means the moment a company uses debt or loan, it has committed itself to pay the interest on that debt or loan. Therefore, it becomes riskier. However, at the same time, it has a positive aspect also. If earning of the company is increasing, particularly operating income, then definitely leveraged capital structure has positive multiplier effect on the earning for equity shareholders. But when operating profit of the company start declining, then leveraged capital structure is not safe, it is riskier, because it will have negative multiplier effect on the earning for equity shareholders. Now, how these leverages are measured? That is the part of either the financial leverage, number one, or the ratio analysis. So we are not going to discuss that now. Financial leverage we have already discussed in the previous classes. We will discuss some theoretical aspects and then how a manager takes a decision about capital structure. One thing is sure, in general, optimum capital structure is the one at which weighted average cost of capital is minimum. And we say at that level, value of the firm is maximized. Now, before proceeding further, I'll explain how this particular function works. That means relationship between weighted average cost of capital and value of the firm. If you see, there are different thinkers. Few thinkers say that yes, we can assign a particular value to a firm in totality. That means we can make a valuation of the firm in totality, and then once the total value is there, that value can be shared between equity and debt. So according to that approach, which is basically operating income approach or net operating income approach, so we have value of a firm is equal to EBIT, or we can say net operating income divided by overall cost of capital. Overall cost of capital. We can take a simple example. If suppose there are two companies, X and Y, both are having EBIT 200 millions. So EBIT for both the firms is 200 millions. But for firm X, KO, so that is EBIT and this is KO. KO means overall cost of capital, or you can say KWC, that is weighted average cost of capital. How weighted average cost of capital is calculated? We have already seen in the cost of capital calculation in detail. So let us say overall cost of capital of this company is 16%, or for this company is 20%. Reason may be anything. Either company X is getting loan at a better bargain, company Y is getting loan at a poor bargain, maybe a scenario, or one is leveraged, another is unleveraged. I am not disclosing right now, because I have taken a hypothetical example to explain the relationship between overall cost of capital and value of the firm. Now, simply calculate value of the firm. So when I divide this 200 by 16%, so 200 divided by 0.16, I get a value. So value of X firm, value of X is simply 1250 millions. Whereas value of Y will be, I hope, 100 million, 1000 million. So value of Y is 1000 million. So now you can see the difference. You can see the difference. When overall cost of capital is minimum, value of the firm rises, and vice versa is also true. When we increase the overall cost of capital, value of the firm declines. It means there is a direct relationship between overall cost of capital and value of the firm. Now this value of firm may be like this. If I say firm Y is unleveraged firm, we can assume anything just to establish the relationship. And this is a trusted relationship. It is not a hypothetical one. It is not a hypothetical one. You can even say both the scenario are for one particular single company across different periods. Then you can see the effect of overall cost of capital. So company Y is unleveraged company. So we will say value belonging to equity shareholders is 1000. Whereas in company X, 80% of the assets are financed by equity and 20% are financed by debt. Therefore, this value of 1250 will be split into two parts. 80% goes in the favor of equity holders and 20% goes in the favor of debt holders. Now you can see return on equity is better in case of X and is poor in case of Y. So in that way we go for that. In that way we go for that. So that is simple notion to explain that yes, there exists an optimum capital structure, the capital structure at which overall cost of capital is minimum, leading to the maximization of value of the firm. So here we have valued the firm in totality as 100%. Then there have to be some factors which affect the decision about capital structure. So we are going to discuss the main factors. Company to company, situation to situation, factors may be different. Year to year, factors might change depending upon the market scenario, profitability, situation of the company, and many more, or regulatory aspects. So let us see what are these factors which affect the capital structure decision. Now, for designing the capital structure decision, three kind of things have to be considered: quantitative factors, qualitative factors, and managerial factors. Because ultimately it is the philosophy of the management, risk-taking capacity of the management, which will help in deciding whether leveraged capital structure has to be there or unleveraged. If we take a hypothesis that there is a manager or the top management group of board of directors is there, they think that they don't want to take more risk, then definitely they will either go for unleveraged capital structure or low leverage. On the other hand, top management thinks that yes, we can take the risk, we are ready to assume the risk. They will definitely go for leveraged capital structure. That means blending the financing with the help of equity and debt. So ultimately, quantitative factors, qualitative factors, and philosophy or attitude of the management with respect to risk-bearing capacity. However, in all the circumstances, aim of capital structure decision is to minimize the overall cost of capital and maximize the value of the firm, thereby leading to the maximization of return for the shareholders. Ultimately, who is taking the risk? Who is at the helm of the affairs in a company? The shareholders. So finally, the management team is working for the shareholders, and always they will do a decision in such a manner so that value for shareholders, return for shareholder is maximized. And such value comes only when overall cost of capital is minimum. Now, what are the key factors? This is a blend of qualitative, quantitative, and managerial factors. Profitability. Simply, if a company estimates, because everyone estimates, or it is required to estimate what is going to be the future prospects of the company. Now, if company thinks that in the down the line 3 to 5 years, profitability will increase every year. That means operating profits are likely to increase year on year. Then company can easily afford leverage. Company can borrow the money to finance its increasing demand of the investment, because companies go for the diversification, merger, acquisition, and something like that. So if company thinks that either inorganically or organically, I am likely to have more profitability in the future, then definitely leveraged capital structure is better. Otherwise, unleveraged capital structure is suitable. Then liquidity. Look at the fact. A company with high leverage is generally having low liquidity. I'm not talking about other factors affecting the liquidity, but yes, in general, if we classify the things like this, that yes, keeping all the other factors silent, and company has got high leverage. High leverage translates to high commitment to pay fixed interest cost, fixed finance cost, which is called as servicing the debt. So whenever we have high cost in servicing the debt, definitely liquidity is compromised. So it depends what is the liquidity requirement of the company. What is the liquidity requirement of the company? If company wants to maintain high liquidity so that available cash resources can be used somewhere else and not for the payment of interest, then definitely company will keep the debt at a low level. On the other hand, if company thinks I have sufficient cash, sufficient liquidity generated, then company can easily afford a leveraged capital structure. But one thing I'll clarify right now, profitability and liquidity are two different aspects. Generally, we say profitability does not mean liquidity, and liquidity does not mean profitability. Just give a pause and think what is the interpretation of this statement. I'll repeat the statement again. Profitability does not mean liquidity, and liquidity does not mean profitability. Meantime, I'll proceed further with the rest of the factors and I'll explain how to attempt this question if it is in the examination. The question is profitability does not mean liquidity, liquidity does not mean profitability. Explain. So control, third factor, which affects the decision making on the part of management. Now when we say control, it means the top management or the shareholders, that is majority of the shareholders, what is their attitude towards exercising control over the company. If they think that my company should be closely held company, a closely held company is the one in which majority of the shares are held by few investors. It may be a family business, it may be group of people who are intending to control the company. In that case, majority of the funding will be through equity, and that too distributed among closely held people initially. Then subsequently, if they need the money. So I talked about initial funding in a company in which management is desirous to exercise high control. Then first of all, they will have the limited quantum of equity, and that equity will be held by only few investors. It may be a family or members of the family or close relatives. Then in future, if company needs more money, more funds are required, they will not issue the equity. They will rather go for debt, because debt simply does not dilutes the control. Debt simply does not dilutes the control, because debenture holders do not have the right to cast their vote in the meeting. They are only worried about their interest payment. On the other hand, if a company is not worried about control, after the initial issue of the equity, they can come out with a subsequent issue without worrying about the rights issue. They can even go for the public issue, follow on public issue. They are not worried that, okay, new shareholders will come and they will control the company, because they are not intending to control the company. They are not intending to control the company. In that case, a company whose shares are scattered across the n number of shareholders, variety of shareholders, is called as widely held company. Then leverage ratio in the industry. Now leverage ratio means ratio between debt and equity funding. In general, optimum leverage ratio is 2:1. That means for every 1 rupee of equity funding, up to 2 rupee of debt can be sustained. If leverage is very high, company becomes highly risky. If leverage is low, company is safe. So high leverage, that means high proportion of debt funding, translates to high risk for the investors. And when I say investors, for both equity holders and bond holders. Now, it depends what is the leverage ratio in the industry. If in an industry, the common benchmark is say 10:1, that means for overall industry, normal ratio of the leverage is 10:1. Then all the companies whose leverage ratio is 10:1 or below that, they are considered good. And the companies whose leverage ratio, because leverage ratio is also known as solvency ratio, is more than 10:1, which is industry average, then they will be considered more risky. So leverage ratio indicates risk in the company. Higher the leverage, higher the risk in general. Lower the leverage, lower the risk in general. Then comes nature of industry. If your company is in an industry in which earnings are not stable, anytime competitors can come in, anytime market share might get diluted, that means highly competitive industry there is, then definitely you cannot afford committed payment on account of interest. You cannot afford committed payment on account of interest. Therefore, you will go for the equity funding. Because in case of equity funding, we pay the dividend only when profits are there. And that too, if company makes a decision whether to give the dividend or not. And now how dividend decision is taken, we have a separate class for that. But yes, if your earnings are not likely to be stable due to the nature of the industry, then definitely you will go for the unleveraged capital structure, else you will go for the leveraged capital structure. Then consultation with investment banks and lenders. There is something called as loan covenant. Loan covenant means restrictions imposed by the money lenders, bankers, or the financial institutions. Now, sometimes what happens, a company has already taken a loan from a bank or financial institution. Now, at the time of giving a loan, bank or the financial institution, that is money lender, might impose a restriction that company, if needs subsequent money, they cannot go for the more debt. Rather, they will have to go for the equity only. The reason is apparent, because if subsequently company goes for more debt, then safety or security of the other debt or earlier debt might be compromised. Scenario may be different depending upon the agreement and loan covenant, but yes, sometimes the money lenders or the financial institutions might impose certain restrictions regarding maintaining the debt equity ratio. So suppose initially company takes a loan from X financial institution and they impose a restriction that in none of the case debt equity ratio should go beyond 1.5:1. Then definitely before raising the further capital, company will have to think about this ratio. If right now a company is at 1.5:1 ratio and they need more money and loan covenant says ratio cannot go beyond this. So the factor leverage ratio in the industry particularly means what is the industry average about leverage ratio. In general, what we have 2:1 is considered as the normal standard for debt to equity. That means for every 1 rupee of equity, up till 2 rupees of debt is fair enough. However, the moment debt equity ratio rises, company becomes more risky. The moment debt equity ratio is low, company becomes safe or less risky. Now, whether a company's debt equity ratio is indicating high risk or low risk, in isolation we cannot do that. We have to see what is the industry trend, what is the industry average. So industry average simply tells me, suppose in a particular industry, debt equity ratio is average 10:1. So when we say industry average means for all the companies in that industry, debt equity ratio put together is 10:1. It means all the companies for which debt equity ratio in that industry is less than or equal to 10:1 are considered optimum, whereas companies with high debt equity ratio in that industry will be more risky. So that is the way we can decide. If in my industry 10:1 is fair enough, then okay, no problem. Companies which have got the 10:1 or less ratio, I can invest in that one. Or company can decide about the funding, whether to go for the equity or debt. Then comes nature of the industry. Nature of the industry simply tells me what is going to be my volatility of the earning, volatility of the sales. If a company is in such a business that sales is highly volatile, operating earning is highly volatile, then it cannot afford debt, because in an year when earnings are low, it will face difficulty to pay the interests. So depending upon the nature of the industry, they can decide what should be the blend of debt and equity. Then consultation with investment banks or lenders. Sometimes when a company goes to take a loan from a financial institution or from a bank might impose some loan covenant. Loan covenant means restrictions as per the norms or the terms and condition of the money lender. or the person who is financing the particular part of the asset. Now, bank might say that in none of the case, debt equity ratio of a company should exceed 1.5:1. So initially, let us say in the year 2000, company takes a loan. At that point of time, ratio is 1.5:1 and bank has given a loan of 100 crore. Now, since the money lender or the bank has imposed a loan covenant regarding debt equity ratio, so that is an example only. Now, subsequently, whenever company needs the money, till the time bank loan is outstanding, company has to maintain this ratio. And suppose loan has been repaid, then company is free. So loan covenant plays an important role in deciding whether company should go for the equity funding or the debt funding or a mix of that. Then timing. When I say timing of the market. If equity market is rising, you have seen equity market keeps on fluctuating. So when equity market is rising, people are readily applying for the IPO, FPO or rights issue. So a situation in which there is a boom in the equity market, company can easily finance its activities by issuing the new shares. However, a particular moment when market is not at boom, market is declining, recession is there in the market, I am talking about equity market, then coming out with the equity issue might not be a wise decision, because at that time company might fail to procure the desired subscription. Debt funding is more preferable. Another factor regarding timing is, at times loan available in the market is at an economical rate, then definitely company will go for the debt funding instead of going for the equity funding, because in general equity funding is costlier as compared to the debt funding. Then tax planning. As you know, interest is a tax deductible expense. The interest paid on debentures or loan is tax deductible. So if a company thinks that I have to plan my taxation and the moment I go for the debt funding, my tax outflow will be low. So it can have loan or debt in their capital structure. On the other hand, company thinks that I have other measurements, other tools to go for the tax planning, then definitely it is free whether to go for debt or equity. That means it is neutral. It is neutral. So these are the qualitative, quantitative and managerial aspects. One more aspect is their regulatory aspect, which I have not written, but yes, we can discuss that also. Regulatory aspect. By regulatory aspect, we mean sometimes either the government or the regulatory agencies, regulation agencies might impose a restriction on the debt equity ratio or on the type of funding to be used by a company or to be used in an industry. So in that case, definitely company is bound to follow those norms. So those are some of the factors. However, there may be many more factors depending upon the industry or company. Obviously, control falls in the managerial region. Attitude of the management towards risk-bearing capacity falls in the managerial factor. Then there is one more quick tool which can help in deciding the capital structure, because we have dealt with the certain key factors. Now, what is EBIT EPS analysis? EBIT EPS analysis simply tells me the relationship between operating income and the earning for the shareholders. It is also known as ROI ROE analysis. ROI ROE analysis. When I say ROI, return on investment, and ROE is return on equity. Now, ROI, how it is calculated? It is simply EBIT divided by total assets. EBIT is operating income, whereas ROE, so how we calculate ROE? It is earning after tax minus preference dividend. Because as you know, on preference dividend, company is bound to pay dividend at a fixed rate. So earning after tax minus preference dividend divided by equity shareholders net worth, I'll get ROE. Now completely understand the fact. When I say like this, we are talking about the fact how changes in EBIT affect the ROE. Take a simple scenario. If ROI is 16% for a company and it is 100% equity funded, that means all the 16% after paying the taxes. So let us right now do the taxes to be neutral, 0%. And then subsequently we can go for taxes also. So if taxes are 0 for this company, because this is in the backward area or concession zone, then whole of the 16% will go in the pocket of equity owners. So ROE will also be 16%. Now, if this company is desirous to go for the further funding by issuing a debt, so this 16% becomes the benchmark. Why it becomes the benchmark? Because the company can afford maximum 16% rate of interest on a loan. Now suppose they go to a financial institution and financial institution says they will charge them 18% rate of interest. Then definitely company cannot afford that. Reason being, on the total investment they are earning 16%, but how much they have to pay on the loan? 18%. So ultimately that will eat away the earning of the equity owners. That will eat away earning of the equity owners and ROE will decline. On the other hand, company is getting a loan from a bank or financial institution at 14%, then definitely on the money provided by the money lenders, company is earning 16%, but how much they are paying to the money lenders? 14% only. So extra 2% goes in the pocket of equity holders. So one simple notion, if your operating income is likely to be more, that means ROI is at a higher level than the cost of debt. Definitely leveraged capital structure has positive multiplier effect. On the other hand, if cost of debt is lower than the ROI, then it will have positive impact. On the other hand, if cost of debt is higher than ROI, it will have negative impact. I repeat it again. The moment cost of debt is higher than ROI, it will have negative impact on ROE. But the moment cost of debt is lower than ROI, definitely it will have positive impact on the equity owners' earning. So that is the way we can say EBIT EPS analysis helps us in deciding whether to go for the equity funding or debt funding. Now when we go for the EBIT EPS analysis, we always calculate something called as indifference level of EBIT. Indifference level of EBIT is that level of EBIT at which company is neutral to go for any kind of funding. It means if company takes 100% equity funding, then also earning per share remains the same. And if company goes for maximum chunk of the funding through debt, then also EPS remains the same. So that level of EBIT is indifference level of EBIT. So therefore now how this EBIT EPS analysis becomes a tool in taking a decision. Take a hypothetical example. Through calculation we come to know that yes, indifference level of EBIT is 500 crore rupees. So what is that? That is also called as break-even EBIT level. So at indifference EBIT 500 crore is calculated. Now company makes a quick calculation that in the coming 5 to 10 years, what is likely to be the EBIT of the company? So if company thinks that yes, my EBIT in next 10 years will always be greater than 500 crore, then leveraged capital structure has positive multiplier effect on the earning for shareholders. EPS will rise at a faster pace. On the other hand, if company thinks that my EBIT will not be more than 500 crore down the line 10 years, then company should not take the risk of funding through debt, because in that case, debt will have a negative multiplier effect on EPS and ROE. So that is how indifference level of EBIT is helpful in deciding whether to go for equity funding or debt funding. Now how indifferent level of EBIT is calculated, that is not in our purview right now, but yes, theoretically I have explained what is the meaning of indifference level of EBIT. Indifference level of EBIT is the one at which you take any type of capital structure, EPS will remain the same. It means if I say 500 crore is the indifference level of EBIT, and there are three capital structure for a company, A, B and C. A says 100% equity, so equity component is 100%. B says 80% equity and C says 20% equity. It means debt will be just opposite of that. 0 debt, 20% debt and 80% debt. Now, at a level of 500 crore of EBIT, for this company, EPS turns out to be the same. Then company is neutral. They can go for any kind of funding. But as explained, if in future company thinks that yes, I can have operating profit more than 500 crore, then definitely leveraged capital structure will have highest amount of EPS. Leveraged capital structure will have highest amount of EPS. On the other hand, if company thinks that I can earn only less than 500 crore, then unleveraged capital structure will have highest amount of EPS. That is EBIT EPS analysis. So dear learners, I have explained you the factors responsible for affecting the decision of capital structure. Capital structure is blend of different sources of funds used by a company to finance its assets. Keep on learning. Thanks a lot.